How do Monte Carlo simulators work? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. If you've taken any of our courses at Applied Finance Research or studied with Dr. Van Tharp or Dr. Ken Long, my mentors, then you know that Monte Carlo simulations are an important part of our trading system research protocol and an important part of our success in trading. But exactly how do they work? That's the question we're going to answer, and our goal is to explain this in a way that doesn't get too technically complex, doesn't get too math heavy. So the goal is an explanation of this that works for folks who aren't too big into the heavy technical math side of things. So what we're looking at here is a Monte Carlo simulation produced by Market System Analyzer, and that's the simulator that I personally use in my own research. I don't get anything out of telling you about it. I don't have a commercial agreement with the creators. I'm just telling you about it because I love using it. So let's start with the blue line first. That's the equity curve created by the back tests of this particular system over 190 trades. We have 190 trades here, and it's a pretty nice looking equity curve. The equity goes from 100,000 at the beginning to almost 750,000 at the end. Now, this equity curve is created by ordering the trades in their actual sequence in the order that they were taken. But it turns out that that's one of the limitations of a backtest. Why? Because we know that the future will never be the same as the past. It might rhyme, but it won't be exactly the same. And even if we assume that this backtest is in fact an accurate sample of the trades we'll get in the future, those results, those future trades, won't happen in the exact same sequence in the future. So what's important to know is that if we reorder the sequence of trades, our equity curve will look different. It'll have a different shape, a different maximum drawdown, and a different ending equity because of math. That's basically just how it works when you reorder it. So one way to think about how Monte Carlo simulations work is the idea that our system is like a black box, and we can't see inside, but we can reach inside the box and pull out a result. And the result is a trade with a given percent gain or loss. We don't know what the next result is going to be when we reach inside the box, just like we don't know what the result of a trade is going to be at the time that we enter the trade. But if we're willing to assume that our backtest results are a representative sample of the kind of results our system will generate in the future, then we can do a mental exercise similar to Dr. Van Tharp's famous marble game. We take the backtest results, the 190 trades, we put them inside our black box, and we pull them out one at a time in random order. And we draw a new equity curve based on the new sequence of results. Now, at the end of one run of 190 trades, 190 samples reaches into that black box, we will have a new equity curve with a new shape. Now, let's imagine that we repeat that process 500 times or 1,000 times, and we end up with 500 or 1,000 different equity curves on our graph. It would end up looking something like this. So here we've got a sample of 100 backtest trades, and we graphed 200 runs. Each run is a different color, and we can see that there's quite a bit of variation in the shapes of the equity curves because the sequence of trades is different for each run. Each run will have a different maximum drawdown, a different average return, a different ending equity, etc. Now, at this point, it looks like a bunch of dog vomit, to borrow a phrase from Dr. Ken Long, but we can use math to help us analyze what we have here. So for example, we could find the average of all these runs, and that's the black line that's depicted here. We could also find the maximum of all these runs, and that's depicted by the green line here. Or we could find the minimum, that's this red line at the bottom. We could also calculate things like the average plus 1 standard deviation, that's the thick green line, or the average minus 1 standard deviation, that's the red line. There's a bunch of different stats that we could calculate from all of those Monte Carlo runs. Now, going back to the Monte Carlo simulation from Market System Analyzer, let's take a look at the other lines on this graph that we haven't talked about yet. We know that the blue dots are the backtest trades in their actual sequence. The gray line is the average line of the Monte Carlo simulation, and in this case we did 1,000 runs of the 190 trades. The red line is the upper 95% confidence interval, and the green line is the lower 95% confidence interval. But what does that mean? So it means that of our 1,000 runs, 95% of them were no lower than the green line at any given point on the equity curve. And of our 1,000 runs, 95% of them were no higher than the red line at any given point on the equity curve. So we could pick a point along the curve, let's say trade 100 right here. And we can say that if we lived 1,000 lifetimes or 1,000 parallel universes in which we took the 190 trades from this system, in 950 of those lifetimes, our equity would be above the green line. Let's call that 200,000 here. And in 950 of those lifetimes, our equity would be below the red line. Let's call it 400,000. And on average, our equity would be where the gray line is. Let's call that 300,000. We could also do a similar analysis for maximum drawdown. So we could say that in 95% of the runs, the maximum drawdown was no greater than X percent. We could do the same for total return. So we could say that in 95% of the runs, the total return was no less than Y percent. Now, of course, this is given all the assumptions of using a Monte Carlo simulator, which includes assumptions like we're only taking one non-correlated trade at a time, the assumption that our backtest is in fact a representative sample of the future, et cetera, et cetera. Now, that's a video all of its own. But the important element here is that the Monte Carlo simulation gives us much more insight into what our results could be in the future as compared to the single run of the backtest trades in their actual sequence. And this is really critical. A major mistake that less experienced traders and investors make is that they don't understand the limitations of backtests. They put too much faith or confidence in those backtests, and then when their results don't look like the backtest, they don't understand why, and they give up on what could otherwise be an excellent system that is in fact operating within the statistical parameters predicted by a Monte Carlo simulation. As Dr. Van Tharp always said, the goal is to survive the worst case in the short term so we can achieve the system expectancy in the long term. So that's a simple explanation of how Monte Carlo simulators work. This is Bill Scheid from Applied Finance Research. Thanks for watching and happy investing.